Imagine a nation the size of a city sending ripples across global markets. Singapore, one of the world's top financial hubs, has just called a general election, and investors from Wall Street to Shanghai are on high alert. This isn't just local politics, it's a potential market-moving event. Will a political shift in this tiny city-state rattle stock indices and currencies worldwide, or will continuity keep markets calm? Let's break down how Singapore's upcoming election could shake global markets and why traders everywhere are watching. Singapore will go to the polls on May 3rd, 2025. This sudden announcement means campaign fever is in full swing. It's the first electoral test for Lawrence Wong, the new Prime Minister-in-waiting who took over the ruling party's leadership from Lee Hsien Loong. The People's Action Party, or PAP, has ruled since 1965 and is expected to win again, but their vote share has been slipping. In 2020, they hit a historic low, and opposition parties like the Workers' Party gained serious ground. This time, 97 parliamentary seats are up for grabs, 4 more than last time. For Lawrence Wong, a strong win would cement his mandate, a weaker result. That could signal a generational shift in Singaporean politics. And that's where investors start paying attention, because political shifts can lead to policy shifts, and policy shifts move markets. Now, let's set the economic stage. Singapore is a trade-reliant country, and global headwinds are strong. The government just cut its GDP growth forecast for 2025 down to 0 to 2%. Why? Rising trade tensions, especially with new tariffs from US President Donald Trump, and broader global uncertainty. The central bank even eased monetary policy recently, a clear sign they're bracing for turbulence. Ahead of the election, the government introduced a budget packed with subsidies and rebates. But after the votes are counted, investors are wondering, will that generous spending continue? Or will Singapore tighten the belt? If policies shift toward populism or domestic social spending at the expense of pro-business growth, investor enthusiasm could fade. If they double down on economic strength and foreign capital, markets might cheer. So how might global markets react? First, investor confidence. A clear PAP win will likely reassure investors and signal policy continuity. Singapore's stock market could see a short-term bump. But a surprise, like the opposition gaining more seats or a weaker PAP mandate, could cause temporary volatility as investors re-evaluate their positions. Next, the Singapore dollar. It's often seen as a regional safe haven. We might see some cautious hedging ahead of the vote. But unless the election outcome is a shock, the SGD should stay relatively stable. If things go as expected, it'll keep trading based on external factors like US rates rather than politics. And finally, foreign capital and trade flows. Singapore is a magnet for global capital and a key player in Asia-Pacific trade. A stable election reinforces investor confidence. But any signs of political instability or future policy uncertainty, even slight ones, might cause hesitation from investors parking big money in Singapore's banks, real estate, or startups. In the big picture, Singapore's election is more than a local affair. It's a signal to global markets. Will the city-state maintain its reputation as Asia's most stable economy, or will rising domestic pressures lead to a subtle change in direction? Either way, smart investors will be watching closely. Want more updates like this? Stick around. The world doesn't stop moving, and neither should your money.